Okay, in this video I want to talk to you about market entry orders, how you enter the market. Now when you enter a market, you're either buying or selling. Clearly if you're buying something, you want it to go up in value. It doesn't matter what it is, if it's a forex pair or anything in life, you want it to increase in value. And indeed, if you sell something, you want it to go down in value, so at some point you can buy it back at a cheaper price, same as the forex markets. Now let's assume an example here based on the most commonly traded currency pair, the euro against the US dollar. Now let's assume the euro US dollar is trading on your screens at a price of 1.15. That means you can buy or sell at 1.15. Remember, if you're buying, you want it to go up. If it's selling, you want it to go down in value. Now, there are two types of ways you can enter the market. Basically, you can use a pending order or an at-market order. And we'll explain now the difference between the two. First of all, we'll look at a pending order. Now, a pending order basically means that you want to enter the market, but not at the price that you currently see on your screen. You want to enter a buy limit order. Now, normally in life, you want to buy things cheaper than the current value. So a pending buy limit order would be below where the current market price is. Remember, buying, you want it to go up in value. So you want to leave a buy order because it's going up in value, but not at that price. You think it might come down a little bit. Your trading strategy says you should be buying the particular currency pair, the euro against the US dollar, but not at this price. It's got to come back down a little bit. So for example, you might want this to come back down in value to a cheaper price at 1.13. And here you leave an instruction with your broker, which you can do online with on your trading platform, to buy that particular currency pair at a lower price than where it's currently trading. And in this example, we want to buy at 1.13. Now, the market might get back down, it might trade back down. You think, oh yeah, this is getting near to me. It might hit 1.14. But it doesn't execute your order until it gets back down to your limit. This is your buy limit price. You're not prepared to pay 1.14. Yes, it's come back down, but not to the limit that you've stipulated. In which case, your transaction wouldn't take place. It won't take place until it gets down to your limit, your price limit, which in this case is 1.13. This will be a buy limit order. Now, conversely, you may wish to sell this particular currency pair, the euro against the US dollar. The current market price is 1.15. Now you want to sell this, but you want to get a better price. You think this is going to go up in value. Like buying a house. You might want to sell your house, but you might think, oh, I'll sell it in a year's time, I get a better price for that. Same as the forex pair here, trading 1.15, you want to sell it, but not just yet. You want to get a better price. So for example, you may have a sell limit placed with your broker. That's an order to sell the euro USD at a higher price than where it's currently trading. So if the market does trade up, it might get to 1.16. Are you going to sell at 1.16? No, your limit is 1.17. This is your sell limit. That's the price you're prepared to sell at 1.17. So the 1.16, you're not going to get a trade done. You're waiting to reach your specified limit. This is basically a sell limit order. Now, another way that we enter the market is with and again, it's a pending order, it's a sell stop or a buy stop. Let me explain the difference between the two. So again, the example, euro USD is trading 1.15. You might have a buy stop order. You have a strategy that says, yeah, I should be buying the euro USD, but not at this level. You need price confirmation. And that's only confirmed if the euro USD goes up in value to a predetermined level. So you might say, your strategy might say, yep, but I need it to move up just another small fraction in price. So your buy stop could be placed at 1.16. So indeed, the markets are fluctuating, moving up and down. You still haven't executed the order. The moment you see a price hit 1.16, your broker will execute that trade for you automatically and you go long the market. When I say go long, it means you're buying the market because you think it's going to go up in value, so at some point you can sell it for a profit. So that's basically where your buy stop would be, placed above where the current market price is. And again, conversely, you may have a strategy that says that the Euro USD is going to go down in value. Okay, so you want to sell it because it's going down in value. You want to buy it back at a later time at a cheaper price. But you don't want to sell it here until you get confirmation. And that confirmation might come in at a lower price, say at 1.14. So again, market's trading down. The moment it hits 1.14, your broker automatically executes the trade for you and you sell the Euro USD at 1.14. This is called a sell stop order. A sell stop. So you can see these sell stops, buy stops are great ways to enter the market when you need additional confirmation of the direction of the move. Now, another way to enter the market, which is a much more simpler way, is to enter at market. At market basically means you're prepared to accept that price that you see on the screen. Clearly, if you think the Euro USD is going to go up in value, you would want to buy it. So you would click the mouse to buy at this price, at 1.15. And the broker would execute that trade automatically for you the moment you click the mouse button. If you think it's going up, you hit buy. Clearly, if you want the market to go down, you'd hit sell. And you would be assuming you're going to get this price. Now, of course, in reality, the price might differ somewhat by a few pennies or so, but that is the price you're willing to accept, or price very close to that. So that's the two basic different types of ways you can enter the market, by doing it now instantly at market, or by waiting for a better price or confirmation of price further down the line. Now, in future videos, I'm going to show you exactly how we use these when we're talking about strategies and how these become very, very effective ways to enter the market.